Welcome to Smarter Markets, a free weekly podcast featuring stories from the entrepreneurs and icons of commodities, capital markets, and technology, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we explore the questions: is capitalism in crisis? And will building smarter markets be the antidote? And now, here's your host, Eric Townsend.
Welcome to the 9th episode of Smarter Markets, a weekly podcast that explores how financial markets could be redesigned and improved to better serve market participants and society as a whole. Smarter Markets is made possible by a grant from Abex Technologies. I'm your host, Eric Townsend. Several of you have told us that you particularly enjoy our Commodity Legend sub-series of guests who are multi-decade veterans of commodities markets. And it does seem to be a curious law of nature that commodities guys almost always have interesting war stories to tell from their careers. This week's guest is MBF Trading founder Mark Fisher. Mark has been an active participant in commodities markets for decades and began as an open outcry pit trader. We'll discuss Mark's career, including a war story or two, and then consider how markets could be improved to better serve market participants and society as a whole. My interview with commodity legend Mark Fisher is coming up next.
And now, with this week's special guest, here's your host, Eric Townsend.
Mark, thanks so much for joining us on Smarter Markets. I've got a problem I need your help solving because we had Robert Friedland come on and tell our listeners the story about playing camel polo in the snow. And so far, nobody's been able to top the story. But I happen to know that although I've studied trading and risk management, you're the only guy in the industry who uses the Hudson River as a risk management tool. Please tell our listeners how that works.
Well, Eric, I'd be happy. I'd really like to know who told you that story. But anyway, growing up in New York, there was the off-track betting site. And it was called OTB. And they still have it in New York. And OTB has a slogan, bet with your head, not over it. And one of the first things I try to instill in all the interns and new traders that we get is exactly what's your risk reward? I mean, is the bet worth taking? What you're risking, is it really worth what you're going to get? And especially with kids in the ages of 16 to 25, and I've started training people as young as 12. You know, that concept to be able to bet with your head not over it is something you really need to get ingrained in their head. So typically what would happen is, because back then when I was in my 40s and late 30s, and, you know, I was pretty good at a 40-yard dash, because if you know, a 40-yard dash is not really about running, it's just about getting off the line. All these young kids that would work for me would think that, you know, there's no way that we can lose. We're going to bet with him on a bet. And every time that I would make this bet, I'd make the bet where if I lost, I'd pay them money. I know they wanted to go out in New York City that night. They wanted to go to dinner. They wanted to go someplace which was a little more, how should I say this, risque than dinner. I didn't really care. But what they lost was they had to do something that was embarrassing. To me, embarrassing meant, okay, it's middle of January. You got to jump in the Hudson River right by the New York Mercantile Exchange. You cannot believe the number of people who ultimately went on to become successful hedge fund managers, who work at big banks, hedge funds, who at one point or another ended up in the Hudson River. And that lesson of teaching people, really, what are you risking? I mean, is it worth what you're gonna make? That whole bet proposition is something that I think that I try to instill in everybody as soon as they get to know them. And that's how that Hudson River happened. So in the example that you're talking about, it was like beginning of February. I had a bunch of, kids that really they thought they knew what they were doing. I made them, again, the same stupid bet I always make. Of course, I beat the kid that I was going to race in. And of course, I had to get 6 kids in the middle of February, jump into the Hudson River right by the new NYMEX building at the time. Of course, I had to get the New York Fire Department that I was friendly with and a police boat to come help us, and that cost me a couple of $1,000s. And probably 7,000 people who were in the World Financial Center got, a good laugh. But, it was worth it for them. It was fun for them, and it actually turned out to be a good lesson for everybody involved. But that's just one of 1,000 stories.
Tell us a little bit about how you got involved in this business. I'm particularly interested that it sounds like, starting a trader at 12. How did you get involved in this business, and why? I can already tell that helping young people realize the shortcomings of youth and recognize how to start to understand risk responsibly. Sounds like something you're passionate about. How did that come about?
Well, I started training people at 12 because that's when I started. I grew up in a middle-class neighborhood, and I kept seeing someone who lived down the block from me come home with nicer and nicer cars every month. So basically one day I went to bang on his door and I said, what do you do for a living? I'm Mark, I live down the block. And he said, what do you care? And shut the door in my face. But lucky for me, one of his sons that I was friendly with, how should I say, needed help in school, being tutored and everything. And I went back with a business proposition. I told his dad, if you transfer your son to my school, I guarantee he'll graduate. You don't need to send him to boarding school or to another school. And he said, okay, what do you want in return? I said, I want to come work for you. He said, you're 13 years old. I said, okay, whenever I can, I can. And that was my introduction to the trading floor, where this gentleman ended up being one of the two largest silver brokers for the Hunt brothers. And my career started at 13 working for one of the two largest silver brokers during the entire silver craziness of the 70s and 80s. True story.
Now, you were in the markets at that time, 70s and 80s. This was what you saw depicted in the movie with Dan Aykroyd and Eddie Murphy, Trading Places, where it's a bunch of screaming guys in a pit, trading commodities the old-fashioned way. You've lived through the transition to electronic markets. I'm very curious how you, as an old-school trader, perceive it, because frankly, in my opinion, as a former software designer, what I see that we've done is we've computerized and automated the same old paper systems without really doing a whole lot of new innovation in terms of designing smarter markets that actually do things the old system didn't do. How do you perceive this? How do you see the current electronic market systems compared to the old pit systems that we used to have?
Well, obviously, in terms of trading abilities, obviously the people that generate code and are able to go ahead and digest a lot of data, and the high-frequency traders, they've obviously created a huge edge for themselves as opposed to when the markets are trading in the pits. But the backbone of these big trading firms off floor today and the hedge funds are still humans. And I'll give you a perfect example. Eric, if you gave me two individuals, in 15 minutes, I could tell you which one will be a successful trader or who will not be a successful trader. And basically, I tell a funny story that I had a guy that came work for me who graduated from Harvard Law School, brilliant person, but he was one-dimensional. He was, he can only do one thing at one time. At the same time, there was a guy who was a very smart guy who was a street vendor who ran an ice cream truck who, would basically, I could see 100 kids go up to him at the same time to order ice cream in the middle of the summer. And he could basically keep track of 100 orders at once. And he knew exactly what everybody needed. And he didn't get, he was able to keep his composure. He was funny. He was quick. And it came down to four things: how quickly you can accumulate data, how quickly you can analyze, decide, and then implement. And those four steps really determined, in my mind, your trading career. And that guy, by the way, from the ice cream truck, ended up being a trader who ended up coming to the floor, I convinced. And he probably made over, I don't even know, something crazy, over $200 million trading. While the guy who was the Harvard genius, very, very smart guy, ended up leaving the trading community after 6 months and ended up working as a big lawyer at some big firm in New York City. So again, the markets have evolved, obviously, from the pit. Obviously, the edge in the pit is all gone. The edge in the pit is gone now to the people who are the fastest to the screen, who are the fastest to the location, who have the best code, who are the best code writers, who have got the best algo designers. But there's still a tremendous opportunity for people who can manage risk, who can understand, who can multitask, and who can do those four steps: collect information, decide, analyze, decide, and then implement. The better you are at it, using risk reward, determines whether or not you can have a career in trading.
I want to talk about how we got to this point, because I agree with you. What's happened is we've gotten to the point where the people that are most talented with respect to coding and technology are the guys that have the edge. But it's not because they came and made the market a better place. It's because they're using computer technology to game the market and to create an edge for themselves against people who don't have that advantage. I have not seen very much innovation in this industry in terms of using computer technology to make the market itself work better than it used to. What I see is automation of old paper systems and very little more than that. And I frankly, if you look at the purpose for which these markets are allowed to exist, it's not supposed to be a casino that allows high frequency traders to get rich. The idea of capital markets is supposed to be to facilitate the efficient formation of capital to support the expansion and growth of business and the creation of employment and prosperity for all of society. In the case of commodity markets, it's supposed to be to provide efficient price discovery so that we can run the economy on all the raw materials that are needed to do it. And what we get to is there's lots of ways, I think, to use software technology to make the markets more efficient at achieving those purposes for which they're allowed to exist. But instead, we use software technology to invent high frequency trading and latency arbitrage schemes and co-located servers that have tiny little sub-millisecond advantages that are used to essentially just scrape money off the top without really providing any benefit to society. It seems to me that the purpose of these exchanges, in the old days, the exchange was like a utility. But these days, it seems that the exchanges are all for-profit businesses, and they seem to be beholden to their best customers, which are the guys that do the most transactions. And that's the guys like high-frequency traders who have the least to do with the purpose for which the markets actually exist in the first place. Would you agree with that? And do you think that needs to change, or do you think it's okay the way it is?
Couple of things. I don't really know if I would call what the machine learning systems do gaming. I mean, I don't agree with that 100%, but you hit the nail on the head. When the exchange went from not-for-profit to for-profit, which, I'll plead guilty that I was involved in getting the New York Mercantile Exchange to do that. Okay. The utility function of the marketplace of the exchanges disappeared, because once you went ahead and flicked the switch to make these exchanges not utilities, but for-profit vehicles, right? Now you have shareholders to answer to, and obviously your largest customers, whoever they may be. And obviously the largest customers are the HFTs and the co-locators and the scrapers, as you call them. And so it's not that the marketplace has lost what it's supposed to be about. It's that the exchanges have a new master. Well, have had a new master, and that's the shareholders and the bottom line. So how do you go ahead and make the markets better for everybody? Okay. I mean, I have some views about that, but it's a much more complicated issue now when you have to answer to not just, first of all, the regulators, secondly, shareholders, and then really the market consumers or, the beneficiaries markets really come last.
You said you have some ideas about how to make the market better. Go ahead and hit us with those. What can we do to improve these markets to make them better serve both market participants and society as a whole?
See, I think that I would slow everything down a little bit. I think that I would slow everything down, by a millisecond or two, so that people could go ahead and so that the advantage of the HFTs would be less. I think that also when you look at a price on the screen, like right now I'm looking at, January crude trading 46.13. It's not really trading 46.13 because there's by the time it's on my screen, it's already delayed, right? And people don't realize that. What you see on the screen, so if market participants or hedgers just use the screen then with your naked eye, you're not really seeing the real market, especially when it gets really busy. I also think that what should happen to the markets is that if I'm a buyer and I'm adding liquidity, then I basically should go ahead and not have to pay to trade because I'm adding value to the market. If I'm a market maker and I'm basically trading around that order, well, then I should be the person that has to pay more. So I think that people that add liquidity should basically trade for free or get paid, and the people that take liquidity or the market makers or the HFTs should pay the entire freight. So at least in that case, if I'm a hedger or if I'm a farmer or if I'm an oil company or if I'm an exporter and I'm adding liquidity to the market, I don't think those people should pay to trade. I think it all should fall on the people who are making the markets around them.
Well, I certainly agree with that. And I mean, I'm on the trading side of this. I think that markets should exist to serve society by allowing the economy to work. And if guys like you and I are going to figure out how to make a buck on the side of that, it's fine. We provide extra liquidity. We help the market get better in the process. But the purpose of the market should be to facilitate commerce and to allow efficient price. The reason to have the crude oil market is to allow people who need to buy crude oil and people who need to sell crude oil to do those things. Guys like you and me who speculate and buy paper contracts and settle them without taking delivery, we do add liquidity. We're providing some benefit, but the market doesn't exist for us. It's just something that we can benefit from.
That's a tough question to answer because, today everything is to some degree about the bottom line. So what you're basically saying is it may be time to start a not-for-profit market. Go back to have another exchange where how much it makes doesn't really matter. Maybe just like you said, for social good and social welfare. But the way the markets are constructed right now, it's all about speed, like you said. It's all about edge. It's all about reacting. And I think that's a tough sell for the mandate to revert back to what it was, 30 years ago before these exchanges were for profit.
I'd like to run some ideas that I have past you for how I think we could make these markets serve the marketplace better. But first, to set this up, I want to make sure that we explain some concepts to our listeners. So let's go through a hypothetical scenario. Suppose that you are a hardworking farmer and you go into the futures market to hedge your current crop. Let's say you're a soybean farmer. You're going to sell soybean futures when the price is right, when it's profitable, effectively locking in that price for your crop. So even if the price goes down between then and when you ultimately sell your crop, you're going to be okay. You have essentially protected your profits so that you're going to be able to be a responsible businessman, pay your employees, meet your payroll, and go to bed at night knowing that you're a responsible guy. Now, suppose that meanwhile, I'm a complete cowboy, reckless psychopath who is going to go into the market using the same broker that you use. I'm going to go in and I'm going to be writing naked calls on VIX futures. That's one of the strategies that these guys that are Target store managers have left their Target store job to go and do, and it works beautifully until the day that it doesn't, and then it blows up spectacularly. If I do that, I don't think it's any surprise to most of our listeners that I could blow up my whole account and lose all my money by trading in reckless ways like that. What I don't think a lot of people, and frankly, as a Series 3 futures trader, this is not on the test. I don't think a lot of professionals know this. If I blow up my account, if I really screw it up really badly, I can blow up your account. The hardworking farmer can lose his money because another guy who's a client of the same futures broker does something reckless and stupid. Explain how that's possible, Mark, because I don't think a lot of people understand it.
Okay, I'll explain that, and then I'll even go one step further. So what ends up happening is when a customer trades, his money is deposited into a customer segregated pool at an FCM, a futures commission merchant. So if the pool of money that's in that futures commission merchant, okay, for one reason or another, just like you said, a customer blows out. And if the customers, let's assume the customers in total have $2,000, $200,000, $200 million, it doesn't matter the number. And if a customer blows out, and if the FCM does not have enough capital of itself to backstop what the customer lost, ultimately what ends up happening is it becomes an issue. Who eats that loss? Is that loss an issue of the clearing firms that make up that all participate in the guarantee fund of the exchange, or does it fall to the customer? And what's happened in certain times, I mean, if you look at what happened in MF Global, okay, it wasn't even a customer that blew out. It was the FCM that was trading in, European derivatives that blew up the firm. And I think the best way to describe this is that basically when people go ahead and put their money into a commodity account, they don't have SIPC insurance like you do in securities. Basically, you're relying on the creditworthiness and the amount of money that the FCM has behind it, and then ultimately, what does the guarantee fund pick up in terms of if that FCM has a problem? But ultimately, really, I think the way to address this, if you really want to do this, is for the exchanges themselves to have more skin in the game. If the exchanges were on the hook for a large share of an FCM default, number one, it would protect the farmer or the customer a lot more. And number two, it would make the FCMs pay even more attention. Not that they don't pay attention. They obviously spend a lot of time doing it because they'd have more skin in the game. And obviously, the more skin you have in the game, the more you're going to protect your you-know-what. So to me, most people don't realize that when you go ahead and have money, even if it's in a segregated account, and if you're trading foreign futures and it's in a non-segregated account, it's even less protected. Okay, that's where you can have a big issue. And I think that the best way to solve that is to have the exchanges themselves on the hook to the customers of an FCM if that takes place.
Let me run an alternative by you, because I think that I certainly agree that having the exchanges take more responsibility makes sense. But these exchanges were designed back, when you had the trading places scenario with a bunch of guys in a room and little paper tickets. You didn't have computer technology. Now, you've already described how people have brought computer technology into these markets for the purpose of creating machine learning trading systems and so forth. So they're making a buck by having that edge. What I'm talking about is, why not have the exchange have high-speed computers so that as soon as that reckless guy, as soon as his account goes margin delinquent and he drops below his maintenance margin, you start liquidating those option positions instantly. You force him to buy back those contracts that he's short. And maybe that blows up his account and it wipes him out. But with millisecond accuracy, the exchange addresses that risk as it starts to threaten other people and actually takes action about it, as opposed to saying, the way the system works today, well, all you FCMs, you brokers, and some of them are little mom and pop shops that don't have very sophisticated software systems, you guys monitor this yourselves. And if your customers start to blow up, you can liquidate your customers. But that usually requires human intervention. It's not very efficient. And we've seen through actual experience that it doesn't always work. You get to situations where before the FCM even figures out that they've got a customer blowing up, the guy's already $50 million, negative equity in his account. The exchange could have liquidated those positions automatically as soon as the account went margin deficient if the exchanges were designed completely differently than they are today. Is the kind of change that I've just described, is that what we need to get to, or are there maybe, negative aspects of that I haven't thought of?
Well, the negative aspect of that is that under the current CFTC guidelines, a customer must be given a certain amount of time to meet a margin requirement, a margin call. So if Mark Fisher goes in, has a margin call and I can't meet it within the time that my FCM tells me, then I should get liquidated. But on the other hand, the way the law is written right now, I have some amount of time to meet that margin call. So the system, the way the rules are set up now, because I can have, I have till the next business day or whatever to meet a margin call, or they can liquidate me, if I know I can't meet it right away, it's much harder to put into practice what you just said, because of the fact that a margin call can be met and that could take a couple of hours, could take up to the next morning and to satisfy a call. So it's not that easy. It's much hard. It's a much more difficult discussion than what you just laid out, I think.
What I would propose, Mark, is that you change the rules. And admittedly, it would require changing some of the rules for how these markets trade. But I would say there should be a requirement for everyone to say, you've got to have some kind of risk management strategy, which is automated, so that under certain circumstances, when certain things happen, you're going to liquidate positions in your account. And the exchange can provide a default algorithm that does that for you, that closes positions in your account if they reach a certain point, or if your account equity drops below maintenance margin levels, or whatever the threshold is. And you could have the opportunity as the customer to say, hey, I want to write my own piece of code. I want to replace that with my own algorithm that's going to decide, it's going to liquidate the positions that I want to liquidate first, not the ones that might have some other adverse impact on me. But that there's going to be a requirement that any customer have an algorithm in place, either a default one that's supplied by the exchange or a customized one that they create themselves, that deals with a situation where their account is going below maintenance margin levels, and to provide some automation for that. It would be a change in the rules, absolutely. Is that a desirable change in the rules, or would you envision that maybe a different direction is needed in order to improve the market?
So there's an easier answer than what you want to do. The answer is limit leverage. Right now, the average futures contract has between is margins anywhere between 6 and 9% of the underlying. If you limit leverage, you're going to have a lot less blowups. You're going to have a lot less need for these margin calls, and you're going to end up solving half the problem you want to do, and you can do it under the current rules. There's no reason why, just like in Bitcoin futures right now, okay? To trade Bitcoin, the exchanges require a much larger deposit. The FCMs require sometimes double margin. So basically, there's really relatively not that much leverage in Bitcoin from the long side. And if you're short side, I would even require more margin. So the answer to your question, the best way to solve this problem is to decrease the amount of leverage that the exchanges and the FCMs allow the customer to have. Because if you had that, the blowups on the customer level wouldn't happen so often. That's what I think.
What about providing every customer with tools that make it possible for them to set thresholds to say, look, right now we have stop loss orders. That's really the only direct mechanism of risk control in terms of things that are supported by the market itself. What if you had the ability for anybody to have their own piece of software, their own piece of code activated as a risk management algorithm that says if there's a trigger event, say margin dropping below a threshold or a certain increase in liquidity, that it triggers a piece of code that the customer can either write themselves or use a default version provided by the exchange that either reduces their risk or takes other action to hedge against a market event?
Well, I know certain FCMs have in place that if you want to, they'll say if my account drops to a certain level, just liquidate all at the market. But on the other hand, this software, most people won't understand it. Most people will then blame it if something negative happens to their account. It's a much more difficult fix than what you say. I think really what ends up happening is a customer who's trading has to have less leverage in their accounts. And by having less leverage, you have less blowups. Think about, do you really hear of any stock accounts blowing up? No, because it's 50% margin. Yes, you can have a crash and you can have some issues, right? But you don't even in the options world in stocks, you don't really have you've never heard stories like you heard like a couple of years ago when we had nat gas go up and there was a big problem because people were short nat gas options, or when people are short, VIX futures and the whole, VIX options and the whole thing blows up. I think it's a simple answer. Decrease the amount of leverage and increase the amount of margins, and 75% of the problem of potential trading blowups will go away. That's what I think.
What else do you see in terms of problems in the market that need to be addressed where we might be looking for ways to design smarter markets?
Well, for instance, all the position limits that the exchanges have said don't seem to make much sense to me. If I have, let's say you and I were trading our own accounts and we shared the same office. In the last 3 days of trading, we could, we each be able to have X amount of position limits. Let's say, I don't know, whatever, if it's nat gas, we could each have 1,000 lots each of 1,000 lots. And let's say you had $1 million in your account and I had $1 million in my account, right? On the other hand, a trading firm that employs 50 people trading under one ownership structure could only have 1,000 lots, while 10 independent traders with much less capital can have 10 times the amount. That's, to me, that makes no sense. The second thing that I think has to be improved upon is, the whole issue of speed being the ultimate decider of these, who makes trades has to go ahead and be taken care of. I think that to some degree, the way you do that is there's a throttle mechanism that the exchanges can in place. It's sort of like the circuit breakers that they put in when the market gets really crazy. Why not have the market throttle to some degree to make it, I think, more transparent to the average person who doesn't have the HFT capabilities, who doesn't have the colocation, who doesn't have, who can make sure he gets the same chance getting filled at a price as the more sophisticated money has right now.
What other tools, if you were going to provide beyond the simple functions that exist today in these systems, if you wanted to provide everybody to level the playing field in the way you're describing, what else would you give them in terms of tools to, give them a fair chance against the very sophisticated traders that we have today?
The problem is that any tools that you give them, the more sophisticated traders are going to out-tool you. You can only deal with what the knowns are. The knowns are speed. The nodes are, co-location. But in every market, in every business, people, figure out edges because of their, how much money they throw at the market, how much manpower they throw at it. And that's why you see like firms like Facebook and the FANG stocks take over, half the world because they have just the economies of scale and have the mass capital. So the other things that I would do for the individual trader, okay, is I would create a market maybe where the only people that can trade in that market are individual traders, right? Now that may be a situation where, the market may be less liquid, but you know that the only competition in that market, right, are people like yourself. And by that way, you're leveling the playing field because you know the person you're trading against is let's say a retail trader. He's not an HFT or he's not as sophisticated. That, that to some degree that may or may not work. I'm not really sure, but everything you described me here is what everyone's frustrated about with the market, but the solutions are not as obvious to me, at least not to me.
Mark, I want to move on to another subject, which I think is, to my thinking, a place where we really need improvement, which is you get into a lot of things that are traded in the over-the-counter market today. In commodity futures, there are some things that are traded on the screen, as people call it, on the exchange. But frankly, a lot of deals really get done by you have to know somebody. So if I want to buy 1,000 contracts of crude oil for immediate delivery, I can do that on the screen. But if I want to do what is actually a more realistic commercial transaction of buying 1,000 crude oil contracts for delivery a year and a half from now, you got to know somebody because there's no liquidity in the market. And if you don't know the right person, you might not get the right deal. They might try to take advantage of you. They can smell it coming. If you're not experienced and you're not really in the market, they'll try to exploit you. Is there a way that we could improve the market to make those things better?
It's funny you say that because I've been pounding the table for the last couple of years that the marketplace needs what I call anonymous RFQ, or what I call can't see, can't trade. What that means is, Eric, you need to buy 1,000 heating oil contracts a year and a half out because you want to hedge. You're a hedger for, I don't know, an airline or whatever it may be. And right now, your alternatives are go to the screen and try to, buy them on the screen. Good luck doing that in a liquid market. Going to an over-the-counter broker where he goes out to his 4 or 5 counterparties and makes you a market, which is just to those 4 or 5 counterparties, or going bilaterally via swap, to a big bank or a big institution. All those three don't really get you the best market. The best market would be if Eric could go ahead, put a request for quote in that everybody in the entire marketplace who has the capability to trade the size of the order. So, for instance, if you put an order in for 1,000 DC-22 heating oil, anyone with a VAR requirement and the margin capability who can trade 1,000 DC-22 can respond to your RFQ. And you then would go ahead and create a market where the entire marketplace could see the order. You're the initiator of it. The market would come in, and if there was a bid or an offer that was good enough, you'd hit it. It'd be completely anonymous. You wouldn't be exposed to just 5 people. You'd be exposed to everybody. And at the same time, what would happen by doing this order, it'd still be, put it in as a block trade. So the only people that would know the order took place, that there was an execution for 5 minutes or whatever it may be, would be the buyer and seller. And this way, the problem with doing what I just said is that basically you're opening up the central limit order book of all these exchanges to block trades. And nobody really has done that at this point. Nobody wants to open up the crude oil market so that, you're opening up the entire market to everybody. Yes, there's an RFQ market now on the exchanges. Most of it's directed so that I can go ahead and, basically get a quote from my 5 most reliable dealers. But what happens if if I'm a bunch of people that have a big backing and I'm sitting in Baltimore, Maryland, where I know there is a group, and I want to go ahead and compete for Delta Airlines or American Airlines or anyone's, or, Mexico's hedge business. I have no idea. But on the other hand, if there was an RFQ market, which was exchange-wise, and my markets are tighter, better, more efficient, I would be able to trade with Delta, not even knowing I traded with Delta, right? And the marketplace would be tighter, more efficient, and, seamless. The pushback of doing this, if the marketplace were to embrace this, is that you'd put 85% of the over-the-counter brokers out of business. Because what would you need an over-the-counter broker for? You'd be able to input your own trades, on the screen, and you'd have your audience of who could respond would be 50 times as much as what it could be now. And basically what would happen to the over-the-counter market, at least in futures, is what happened to the trading floor in the pit when the market went electronic. It'd become a dinosaur within a couple of years.
Help me understand why the current system doesn't seem to be used, because in the CME Direct platform that we have today, there is a create RFQ function. So if you want to say, hey, somebody make me a market, I want to buy 1,000 DEES 22 heat, there's a way to do that, but it seems like nobody pays attention to it. And if you want to get that quote, the only way it really works in the real world is you got to call somebody who will make that market. Why doesn't that system of creating an RFQ in CME Direct ever get used?
Because I think first of all, it's CME Direct. So most front end systems don't have the access to those RFQs, I don't believe. And I also think that you'd have to do it through the TTs, the CQGs of the world to go ahead and create this, especially with CQG, because I know they've been looking to do this with us for a long time, right? To go ahead and create this RFQ that basically goes out to everybody who's got the VAR limit. Most of the business that's done, except in options, and options is a different story, but in futures, right, is directed RFQ business. And I think to some degree, right, because people don't have access to the RFQ function on CME Direct or on ICE, whatever they use, right, it's not used. I think this would have to be more of a front end development where basically FCMs would tie into CQG, TT, whoever else they want to use, right, and create this model, right, to allow this anonymous RFQ to take place. I mean, to be honest with you, CQG has one they can roll out tomorrow. I've been working with them on it for 2 years. We just don't have the right partners to do this with. But it's there. It's going to happen. It has to happen because it makes too much sense. It's too efficient. But it's going to go ahead and change the over-the-counter market in a way that I don't think most people are ready for.
Well, it seems to me that there's something fundamentally wrong with the design of this market, because the way it works today, as you say, you call the broker, you find the guy that can do that block trade, and then you book the block trade in the system. So the exchange is processing the trade if you book it with Clearport. But wait a minute. Why does it ever make sense for you to go buy 1,000 DEES 22 heat futures without giving everybody in the market the chance to see what price that's about to happen at and offer you a better price?
That's exactly what I'm saying. I mean, there's an argument making that if you can't trade to the size of the order, then you shouldn't be able to see the order. So like, for instance, if you're a 50 lot trader and the order is for 1,000 lots, there could be some noise around that. So maybe, it would be limited by the initiator, by the RFQ initiator. Say, I only want this order shown to everyone who could trade my size or who could trade half the size of the order. But again, you're 100% right. Why shouldn't that order be open to everyone that can trade the size and not just to the 5 most favored nation clients of the broker or whatever the case may be? And the market's eventually going to go to this anonymous RFQ system. It has to. They do this in equities in Europe to some degree. And I think that, all these dark pools that, to some degree are trying to accomplish this in equities, but not really the right way because you don't control the order once the order gets in. But here, the initiator goes ahead and is adding liquidity, is looking for the marketplace. And again, I think that the initiator, if you were looking for the market for the 1,000 DEES 22 heating oil and you hit a bid or you took an offer, you shouldn't have to pay anything. The other side should have to pay everything. You should be able to trade basically for free because you're the one that's actually, hitting a bid or taking an offer. You're the one that's usually the more unsophisticated counterparty, and you're the one that's adding to liquidity and adding to what the primary function of the marketplace is supposed to be about to begin with.
Now, I would imagine that if there's an OTC broker listening to this podcast saying, hey, wait a minute, if you do what you're describing, Mark, what you're going to do is you're going to put the OTC brokers out of business, and that means you're going to lose the skill and talent that they bring to the table. They have a network of guys. They know who to call. They can make deals happen. I'm sure, at least according to them, they're providing value that you're going to be forcing out of business that is going to cause, as they would see it, something to be lost there. Do they have a legitimate argument that something is being lost? Or if the system works the way you envision it, the skill that they have isn't needed anymore?
No, I think the skill is going to still be needed. The skill is going to be needed for complicated option structures. I think there'll be still a lot of customers that will want the broker himself to initiate these RFQs for them or to respond because they don't have the expertise in how to respond to them. I think you're going to have a lot of people stream orders against it. I think the market's going to evolve in a healthy way, just like it was healthy for the market to evolve from the pit to electronic trading. I think it's, I don't see the argument. How can you go ahead and say by paying less, by being more efficient, by being more transparent, that's a bad thing? I don't think you can.
Mark, I want to ask you about what happened in the May West Texas Intermediate crude oil futures contract. I was fortunate enough to be short on that day. We got to the point where we traded to negative $37. And I suppose you could make an argument that says, okay, the market is broken if the price of something valuable like crude oil can trade negative that deeply. Or you could make the opposite argument to say, no, the market is designed to find a clearing price. And in a situation where storage space was scarce, that was a negative price is what it took. Now, of course, that was really, if you look at what happened there, I think it was just a really stupid trader in China not understanding that going into the penultimate close, long in size was crazy in that environment. Is the market broken? Does the market need to be fixed? Or is the fact that it was designed to find a clearing price, even if it was deeply negative, a good thing?
I think that the market isn't broken. I think that to the exchange's credit, there was a lot of publicity and a lot of information put out by the exchange itself that because of the storage issues around crude oil at the time that the price could go negative. I mean, if you would have said to anybody it's going to go negative $37, I think everyone would have said you have your head examined too. But again, you hit the nail on the head. It's a matter of how many buyers versus how many sellers were left at the end of the day, right? And again, I mean, I can tell you stories the opposite way. I'll go back. One of my favorite stories is the December heating oil story on December 31st in heating oil back when the pit was open. I remember the highest that heating oil ever traded was $1.02 ever in the history of the contract. And I was basically trading crude at the time. And heating oil was, there was some issues of delivery, and heating oil was trading 94 cents. And I went over to the heating oil pit for the last couple of hours of expiration, and people were trading it. And I kept seeing brokers coming in asking for, where's the market, where's size. And I could tell that there was nervousness in the market that what are people waiting for, the last minute to get out? Like craziness. And eventually there was a technical formation called a point C pivot that we used. And the market did it. So I got, I got long a number of contracts. And sure enough, in the close of December heating oil, the market went from $1 up to $2.20, but the exchange lowered all the prints to $1.70. The market went up 100% in a minute and a half. And the exchange lowered again because people waited till the last minute. How someone waits till the last half hour to go ahead, when you have a lot of size to move, seems to me to be irresponsible. Just irresponsible.
Well, it was, to me, the crazy part about that story was the press never really covered it. Everybody knew that the oil fund in China was long. What was it, 1,350 contracts or something, just below the position limit. What nobody ever seemed to ask in the press is why in the frickin' world would a non-physical market trader stay long way past OPEX into the penultimate close? And the only answer I can come up with is the fund manager had no clue what he was doing.
Unless he was a market maker that was experienced in the market, there's no business for that guy to have been in the market. None. You're 100% right. I mean, I remember I have in my office, my other office down the hallway here, I still have the trading card of sugar back in the 90s when in January, which is not an active month, where the opposite happened. Again, where January when sugar was trading 3 cents and it was the last half hour of the day. And a broker came in and some speculator had to sell it was stuck with a lot of, Jan sugar, and they started selling the market down, and he sold the market down from 2.5 cents, call it 250 ticks. I bought stuff. We bought stuff at 1 tick, not 1 penny, 1 tick from him. It didn't go negative. We bought it at 1 tick, and I said to myself, I'm not going to have a delivery issue here. If worse comes to worse, it's just sugar. I'll figure out how to get a truck there. And the bag had to be worth more than the 1 tick. Eventually the market rallied 100 points, so we got out. But these things, history seems to repeat itself over and over again, where the same mistakes seem to be made by people that have no business being in a market that close to expiration.
Well, and in that particular case, the exchange, I think, does do a pretty good job of explaining that after OPEX day, the reason position limits go into effect is really the market is for physical delivery traders at that point. And they give guidelines. They tell people when to get out. That guy was running a long only, basically, speculate on the price of oil mutual fund in China. And I think he just didn't get it. I think he waited till the last day because it was the last day, and he had no idea that you're supposed to get out of those long positions on OPEX day, if not sooner. And I don't know how you fix that. I mean, the guy just didn't do what he was supposed to do.
There were a lot of issues with different firms that couldn't handle negative pricing, that their screens didn't print negative pricing. These issues will all come out. But again, I think really what it comes down to is if you're not a sophisticated trader, if you're not a sophisticated and you're basically a passive investor, to some degree, the speculator or the in this case the China fund that had no business being there. Why didn't they roll 2 days beforehand? I mean, what was the objective? What was the problem? You saw after this whole thing happened that the GSCI index and the Bloomberg index all quickly adjusted and got themselves out of spot crude and rolled much sooner, so they would not suffer or could not even have the same issue that these other firms had. I mean, also to some degree, now that it happened once, it'll probably never happen again.
Mark, final topic before I let you go. One of the things that we're looking at with this podcast is new directions that people are taking using distributed ledger, blockchain technology, that kind of thing. You're doing a very interesting project that has to do with prescription drug coupons and blockchain. How did that come about? Tell us all about it.
Well, when I was growing up, my dad owned 2 small supermarkets, so I used to go ahead and be in charge of the coupons that would come into the store and mailing them into getting reimbursed for them. And if when you have a coupon and you cut it out of the newspaper, is a coupon a security? No. Can anyone, when you bring it to the CVS or to the supermarket to redeem it, they're not broker dealers. And you can go right online right now on eBay and you can sell coupons and buy coupons up to $1,000 in value every month and get paid money. So a coupon is really a nothing. It's just it's a piece of paper that has really never been addressed by the SEC or anybody. At the same time, in the late 80s, when Genentech ran into some trouble where they needed some financing, they did these contingent value securities whereby they issued people securities where the speculators would put up, let's say, $50 million. And in return, Genentech would say, if our drugs get approved by the FDA, you're going to get, X percent, 10%, 5%, 6% of the gross value of the drugs that we sell. So that came the idea with us of to go ahead and create what's called contingent value coupons. What they are would be basically to create, instead of ICOs, initial coin offerings, to create initial coupon offerings where biotech manufacturers that are in phase 2 and phase 3 that need to raise, anywhere between $20 and $60 million that can't get the financing to develop, to get them passed into these drugs, would go ahead and be able now to issue, again, these contingent value coupons that basically are sold where if these drugs get passed, that the holder of these coupons, whether it be patients, foundations, insurance companies, get X amount of free medication, X number of doses of free medication for X period of time. And what this would do is this would be a non-dilutive way for biotech firms to raise a significant amount of money. This would open up the marketplace for new technologies and for to be discovered much faster. And at the same time, in order to use these drug coupons, the manufacturers would have to agree to price cap these drugs that they're using the coupons for the entire public for a period of 5 to 7 years. So basically, not just the coupon owners would get, free medication, but everybody who's in that space would benefit because the manufacturer would have a guaranteed cap on what he could charge for the drug as part of the contractual obligation of creating this drug coupon. So the holy grail in prescription drugs is how to go ahead and cap prescription drug prices while at the same time still allowing for innovation and creativity and not stifling development. And I think this concept of contingent value coupons solves it. And by using blockchain to keep track of these coupons and the decrement and who owns them and what type of alternative exchange is holds these coupons, and then how do they deliver it to the pharmacies and to the PBMs of the world. This is really going to be a way for us to develop and create incentives to develop many more blockbuster drugs in a much more efficient way, in a way that will limit the amount of hoarding and pricing that goes on right now. Think about it, Eric. If you go to a hospital, okay, and a teaching hospital wants to compete for Mark Fisher's talents, a teaching hospital doesn't have $40 million. There's no way that a Mark Fisher is going to go work for a teaching hospital as opposed to big pharma or to a speculative pharma who has the money. But now, if these teaching hospitals can issue these drug coupons, use this finance mechanism, then all these not-for-profits can go ahead and enter the same space to develop drugs, hiring the best talent, because now they can raise the capital without having to go ahead and that they can never access before. So I think this is a win-win for, whether you're a Republican, whether you're a Democrat, whether you're a Martian, whether you're an alien. I firmly believe this is something where technology and finance are going to solve an issue that's going to create wonder drugs that, much faster than we ever would have done before.
Mark, for our listeners who might want to find out more about that, is there a website that they can look at?
We're in the process of creating one. There's a couple of white papers written out about it. And if you go to indicium.com, I believe we're going to have a whole white paper out about that in the next week or two.
Mark, thanks again for a terrific interview. My guest next week will be Kirsten Stewart, who heads up the Shaping the Future of Media department and is a member of the executive committee for the World Economic Forum, where she leads a team working with the CEOs, chairs, and other C-suite executives from more than 40 global media companies, including Google, Facebook, Tencent, NBCU, ByteDance, and more. We're going to talk about the expanding role of social media in finance and in society generally, and consider the influences social media had taken on, and consider whether and how it should be governed. Listeners, please help us get the word out about Smarter Markets. It's not every day you come across a podcast with guests of the caliber you've heard here on Smarter Markets, and we have a veritable who's who of industry legends lined up for interviews in coming weeks. Your ratings and reviews on Apple Podcasts and other podcast platforms mean the world to us, as does your help spreading the word about Smarter Markets via word of mouth. For the Macro Voices Podcast Network, I'm Eric Townsend. See you again next week for another installment of Smarter Markets.
That concludes this week's episode of Smarter Markets. For free episode transcripts, visit SmarterMarketsPod.com. Smarter Markets is 100% listener-driven, so please help more people discover the podcast by leaving a review on Apple Podcast or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Smarter Markets, its producers, sponsors, and hosts, Eric Townsend and Abex Technologies, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Smarter Markets.